This is Trade Alive with IUX, where markets come alive and trading gets real. Let's go live.
This podcast is brought to you by IUX Trading Platform, elevating your trading experience.
2009. The year global markets crashed to levels no one thought possible. Banks collapsed. Credit froze. The S&P 500 had fallen more than 50%. Investors weren't just worried, they were terrified. Every headline screamed crisis. Every expert said, stay out. And even the most seasoned fund managers refused to buy because nobody knew where the bottom was or if the financial system could even survive. Fear wasn't just in the market, it was in the air. But in the middle of that panic, in the exact moment when the world was dumping everything, one man was doing the complete opposite. He was buying, aggressively. That man was David Tepper, a trader who would soon be known as the man who bought the bottom. And what he did in 2009 became one of the most iconic trades in Wall Street history, a move that helped generate billions, and a moment that permanently carved his name into the legend of crisis investing. But here's what makes his story truly powerful. Tepper wasn't born on Wall Street. He didn't come from privilege. He didn't rise because someone opened a door for him. He fought his way up, from a tough childhood to rejection after rejection, to eventually becoming one of the greatest contrarian investors of all time. And in this episode, we're going to explore exactly how he did it. We'll walk through his early life, his defining mindset, the turning point that shaped his approach, and the decision-making framework that allowed him to buy when fear was at its peak, while everyone else froze. This isn't just a story about a trade. It's a lesson about conviction, preparation, and the courage to act when the world is paralyzed by uncertainty. Welcome to Trader's Journey, powered by IUX Education. This is David Tepper's 2009 crisis strategy, buying when fear was at its peak. To understand how David Tepper became the man who bought the bottom in 2009, we first have to go back, way back, before Wall Street, before Appaloosa, before the billions. David Tepper grew up in Pittsburgh in a working-class neighborhood where money was always tight. His dad worked as an accountant for a local steel company, and his mom was an elementary school teacher. It wasn't a privileged childhood. It was a practical one, built on discipline, resilience, and the understanding that nothing in life comes easy. And from a young age, Tepper showed something unusual. He wasn't afraid of numbers, but he wasn't afraid of chaos. He loved probability. He loved solving problems. And he had this almost stubborn determination to understand how things really worked, not how people said they worked. That mindset would later become one of his greatest strengths as an investor. In college, Tepper studied economics, then went on to get his MBA from Carnegie Mellon. He wasn't the loudest student. He wasn't the smoothest, but he had this relentless curiosity and an almost machine-like ability to dive deep into financial statements. And yet, despite his talent, he didn't have an easy entry into finance. He was rejected by multiple firms. He was turned down by Goldman Sachs twice. He was told more than once that he didn't fit the mold. But rejection didn't discourage him. It fueled him. Tepper finally broke into the industry through credit analysis, a world most people avoided because it was complicated, technical, and filled with uncertainty. But that was exactly why Tepper loved it. He didn't want the obvious jobs. He wanted the messy ones. This was the period when he learned his core skill, finding value where everyone else saw disaster. Through the 80s and early 90s, Tepper built a reputation for being able to analyze distressed companies with brutal clarity. No emotions, no narratives, just data and probabilities. People began to notice something about him. He stayed calm when others panicked. He looked deeper when others walked away. He leaned in when others backed off. Those traits weren't just personality quirks. They were the seeds of the turning point that would eventually make him a legend. Because by the time 2009 arrived, the world was terrified. And for David Tepper, the moment wasn't a destiny he had trained for. It was the biggest test of everything he had learned, every rejection he endured, and every difficult chapter that shaped his mindset long before he ever managed a dollar. March 2009. The global financial system was breaking apart piece by piece. Banks were collapsing. Panic was spreading faster than news could report it. And every day it felt like the world was waking up to some new disaster. Lehman was gone. Merrill Lynch had been rescued. Citigroup and Bank of America were hanging by a thread, one bad week away from disappearing completely. Investors weren't just scared. They were paralyzed. Every headline predicted more pain, more collapse, more contagion. But somewhere in New Jersey, in a quiet office filled with old computer terminals and paper files stacked against the wall, one man was staring at the chaos with a very different perspective. David Tepper, not panicking, not hiding, just watching, calculating, waiting. While the entire financial world was screaming, "Get out!" Tepper was calmly asking a very different question. What if the market is wrong? That moment, right there, was the spark that changed everything. Tepper wasn't watching TV analysts or reading fear-driven headlines. He was deep in the actual numbers, balance sheets, government filings, liquidity requirements, Federal Reserve statements. And he kept noticing something the rest of the world was too terrified to process. The U.S. government was not going to let the major banks die. Yes, the system was breaking. Yes, the banks were near the edge. But behind the scenes, the Federal Reserve and the Treasury were quietly building a massive safety net, one big enough to catch the entire banking sector if needed. Where everyone else saw bankruptcy, Tepper saw backstops, government guarantees, forced recapitalizations, liquidity injections. He didn't see zero. He saw survival. And if they survived, their prices were absurdly, impossibly cheap. Bank of America trading under $3, Citigroup below $1, distressed debt at levels that made no mathematical sense. But here's the key. Seeing the opportunity is one thing. Acting on it is something else entirely. Because to act on it, you had to buy into a collapsing market while the whole world was screaming that you were insane. And David Tepper was ready. There's a moment people close to him still talk about. The morning he made the call, Tepper walked into the Appaloosa trading floor with a stack of printouts under his arm. He didn't shout. He didn't hype anyone up. He just said, calmly and simply, "We're buying the banks." His team thought he was joking. The market was still crashing. Confidence was non-existent. Analysts were predicting a second Great Depression. But Tepper had already run the numbers hundreds of times. He knew what the downside was. He knew what the survival odds looked like. And he knew that if he was right, even partially right, the upside was life-changing. So Appaloosa made the trade. They bought distressed bank debt. They bought beaten-down equities. They bought the very assets everyone else couldn't sell fast enough. Billions in one of the darkest weeks in financial history. This wasn't courage. It wasn't recklessness. It was clarity, a kind of cold, disciplined clarity that almost no one has in moments of pure fear. And then it happened. A few weeks later, the stress tests came out, the tone from Washington shifted, emergency programs expanded. The panic began to fade, slowly at first, then violently. The banks didn't die. They rebounded. And then they exploded upward. Citigroup tripled. Bank of America surged. Distressed debt snapped back with force. Appaloosa pulled in more than $7 billion that year, and Tepper personally earned over $2 billion, one of the highest payouts ever recorded for a fund manager. Not from momentum, not from luck, but from stepping in when fear was suffocating the market. Wall Street gave him a new title, the man who bought the bottom, because that's exactly what he did. Exactly what he did. When everyone else saw destruction, he saw asymmetry. When the world ran from risk, he walked directly into it, with discipline, with data, and with conviction. And Appaloosa? It instantly cemented its place among the top-performing hedge funds on the planet. A firm built on distressed investing suddenly had the greatest comeback trade in hedge fund history. But behind all the headlines, all the profit, all the record-breaking numbers, the real outcome was something deeper. David Tepper proved that in the moments when fear blinds the world, clarity becomes a superpower. When the dust finally settled, something even more striking became clear. Tepper hadn't just made one of the greatest trades in modern history. He had reframed how crisis investing was understood. Appaloosa didn't just recover, it became a global reference point, a case study for how disciplined analysis can overpower market panic. And Tepper? He wasn't just celebrated for the numbers, he was respected for something deeper. His ability to stay rational when the world was losing its grip. That, more than the profit, is what elevated his name into Wall Street legend. So, after all the chaos, the conviction, and the unbelievable outcome, what can we actually learn from David Tepper's 2009 masterstroke? Because his success wasn't luck. It wasn't timing. It wasn't a heroic gamble. It was deliberate thinking, a combination of psychology, strategy, and disciplined risk management. Let's break down the core lessons we can take away. 1. Rational, contrarian thinking. Not rebellion, but reasoning. People often label Tepper as a contrarian, but that word gets misunderstood. He wasn't buying because everyone else was selling. He was buying because he had better information and clearer thinking. Most contrarians fight the crowd emotionally. Tepper went against the crowd mathematically. He didn't ask, what is everyone feeling? He asked, what is everyone missing? That difference is everything. 2. Policy awareness. The hidden edge most traders ignore. Here's what separated Tepper from 99% of investors. He understood one thing extremely well. When governments intervene, the rules of the game change. In 2009, he realized if the Fed guarantees liquidity, if the Treasury backstops major banks, if interest rates drop to zero, then the probability of total collapse collapses with it. Most traders focus on charts. Some focus on fundamentals. But almost no one studies the policy environment. Tepper did, and it gave him an edge invisible to the naked eye. 3. Courage comes from data, not emotion. People romanticize Tepper's trade as bold or fearless, but that completely misses the point. He wasn't fearless, he was prepared. He built models. He studied worst-case scenarios. He calculated the downside if banks got no help and the upside if they received government support. Only after the math made sense did he have the courage to act. True courage is not impulsive. It's evidence-based conviction. 4. Downside-first thinking. The mindset that keeps you alive. Tepper is famous for asking one question before anything else. How bad can this get? Not how much can I make, but what's the worst-case risk if everything goes wrong? In 2009, his downside was surprisingly small. If banks fully collapsed, the Fed would nationalize or restructure them. And if support continued, bank valuations would skyrocket from absurdly cheap levels. The upside was 10 times, 20 times, 30 times greater than the downside. This mindset is pure survival discipline. If you protect the downside, the upside takes care of itself. There's a principle Tepper embodies more than almost anyone. When markets panic, prices disconnect from reality. In 2009, fear pushed valuations to levels that no longer matched fundamentals. It wasn't just cheap, it was irrationally cheap. Tepper didn't buy because he was brave. He bought because fear had pushed prices far below intrinsic value. That's the ultimate paradox of markets. The scariest moments often produce the greatest opportunities because emotion creates distortion and disciplined analysis brings clarity. 5. Fear creates the deepest mispricing. David Tepper didn't win because he predicted the future. He won because he understood the present more clearly than anyone else. He saw irrational fear, policy support, extreme undervaluation, limited downside, and massive upside. And he acted with a mindset forged from discipline, not adrenaline. That is his real legacy. So that's the story of David Tepper in 2009, a moment where fear ruled the world, yet one man saw clarity where everyone else saw chaos. If there's one message to take away from today, it's this. True conviction isn't loud. It's logical, disciplined, and grounded in reality. And now the question turns to you. When the next wave of fear hits the market, will you react emotionally like the crowd, or will you look for the opportunities hiding underneath the panic? If today's deep dive gave you something valuable, a new perspective, a mindset shift, or just a spark of curiosity, share this episode with someone who might need to hear it. And if you want to explore more tools, insights, and free educational resources to sharpen your trading mindset, visit IUX Education. Thanks for listening. Until next time, stay disciplined, stay aware, and keep learning.
You've been listening to Trade Alive with IUX. Ready to put these insights into action? IUX is here to power your next winning trade.